Welcome to this Killick Explains video. And as markets have sort of drifted upwards this year, I thought it was important to just mention something, which is why stock bounces matter. Now, in the news, you don't hear about them as often as stock drops. And that's because the media like things going down. It's more newsworthy. We're fundamentally pessimists, according to the people who run newspapers. We're also loss averse, so it plays to our fears. Loss aversion is a bias we all suffer from, and it's mathematically founded insofar as if you lose 50% of an investment, you need 100% gain to recover it. All right, but the reality is we tend to therefore be super cautious sometimes. We don't want to lose money more than we want to make it. So people focus hard and fast on the risk of losses of things going down, and what they miss is that bounces are super important to long-term investing, and stocks often bounce quickly and aggressively. All right, make no mistake. And there are three reasons. So I just want to remind you what those three reasons are, what the ramifications of this are for long-term investors. Three reasons are sentiment, technicals, as I call them, or technical analysis, and short covering, which sounds a bit grim. I'll try to explain it very quickly. So three ingredients that can cause stocks to zip up immediately after they've fallen short term. So first of all, sentiment. Sentiment, this is basically saying that people and crowds and markets are irrational. All right, they tend to get too excited on the upside and too fearful on the downside. And stocks, therefore, are volatile over the short term. And the point being, if you know that, you need to not fall into the trap of becoming part of that crowd that either pushes stocks up beyond their natural intrinsic worth or just panic sells as the market dips, throwing, if you like, the baby out with the bathwater and running to cash. All right, so you've got to manage that balance between greed and fear. And simply automating on a monthly basis what you invest is one very simple way to do that, but there are others. So that's number one. Second reason why stocks dip sharply and then bounce quite often is what I call technical analysis. There are people and computer programs out there built around the idea of identifying, using history, what are called resistance and support points. And a resistance point is where historically stocks have struggled to get above a certain number, a certain line, see on the chart. Support points are where when the market dips, historically, now the past is not always a reliable guide to the future, but traders look at these things. Historically, markets have tended to find support. In other words, there is a price where buyers have tentatively or enthusiastically come back into the market. Now, if you think about it, if these exist, even if you don't know where they are, what that means is there'll be algorithms and programs set up to exploit them. And that's why sometimes stocks will hit a point and then suddenly turn up, even if you kind of weren't expecting it. Or they'll move up and then suddenly dip. All right, and there's not much you can do about it. Unless you're a day trader, a technical analyst, you won't know where these resistance and support points are. Not everyone follows moving averages and the like. It's quite technical, but just being aware they're there will make sense in the context of what we do next in a moment. So sentiment and technical analysis explain some of those bounces. And the third thing is short cover. Now, people who short stocks, hedge funds, for example, are able to bet on prices falling. This is not something you and I can do very easily. What they can essentially do is sell shares they don't own, wait for prices to fall, and then buy them back to close the position. Because a transaction is a purchase and a sale, or in this case, a sale and a purchase. All right, it's just that they can do the sale first. And if you think about it, if you were able to sell shares for, say, £100, buy them back for, let's say, 80, you've made a £20 profit, just like someone who buys them for 80 and sells them for 100. So it sounds a bit weird, but there are people who can do that, and they're betting on prices falling. They're pessimists, if you like. So far, so what? Well, the point is this. If you bet on prices falling, which is pretty risky, and the market doesn't play ball, because you're not the market, and share prices actually rise while you're waiting to buy the shares back, okay, that ultimately you need to deliver from the person you borrowed them from, you can get a bear squeeze. And without going into the technicals, what this creates is a short, sharp bounce in the price of the stock you're talking about. Even if you don't fully understand what's going on, it's called a short or a bear squeeze, and it's hedge funds and the like frantically just buying back shares in the market for no other reason than they've got to do that to close out these short positions. So you've got three factors: sentiment, technical, and short covering. all right, all of which can lead to a kind of flip in the market on the upside, a bounce. Now, why does this matter? The reason it matters is that the way markets work is you quite often get the best short-term bounces after the worst drops, all right? And if you're the kind of person that's going to see the market drop and bail out, sit on the sidelines, you're going to miss all those bounces. And countless studies, one by JP Morgan, 10-year study, have shown that if you miss those single best investing days where the market does bounce because of what the three factors I mentioned or some combination of them, that can seriously damage your long-term returns. I mean, just by missing 10 of them over a decade, you can up to halve the annual return you make. Sounds crazy, but that's the strength of this bounce effect I'm talking about. Plus, it's stressful. And if you pull your money out of the market and wait on the sidelines and miss the bounce, you then got to think, well, when do I go back in? So the solutions to avoid this hassle and to sort of take away the temptation to dump stocks when the market falls, try and be regular, systematic about the way you invest. I mean, a very simple formula would be a monthly regular investing pattern that sees you go in on the highs and the lows as well. Ignore the news as much as possible because the news is more pessimistic than it is optimistic. That's just a rule of thumb. Pessimism sells, as I think Lord Beaverbrook once put it. And try to reduce the urge to fiddle with your portfolio. Don't get too clever. Although I've talked about sentiment, technicals, short cover, just commit to time in the market. Don't try and play these short-term movements. You are not a day trader, and nor should you be. And if you do that, you'll reduce the chances that you miss some of these really important stock bounces. Now, to find out more about that, I've got other videos about all sorts of aspects of equity investing. So that's killick.com on the resources hub, if you like. There's also my How to Invest in Equities guide that talks a little bit about this stuff up front. And then there's Confidant if you want to hear it from, for example, our research team in our quarterly magazine.